Good afternoon, boys and girls. Welcome to the Liberty Call. It is Wednesday, April 27th, 2022. Hump day. So, hope everybody's having a great day out there in the interwebs. It is a gloomy day here in Larkspur, Colorado. It is pretty overcast, and there's a fire over by I-25, which is blocking up traffic on the freeway between Springs and Denver. So, if you're trying to get from one to the other right now, it's probably not a good idea because there's really not another way to get from Colorado Springs to Denver other than 25. So, sorry if you're stuck in traffic and watching this later. So, anyways, like I said, pretty gloomy day, but we could probably use some rain here. I hear a lot of the folks in the Denver area complaining about droughts and how the world's going to burn up. I think too many of these people are on the climate change bandwagon. I frankly don't see it. And most of the debunking stuff that I follow pretty much shoots holes in most of that stuff. So, anyways, no one came here to hear about my opinions on the climate, but let's go ahead and jump in and take a look and see how the markets did today. They were up quite a bit earlier today, but have dropped back down. The Dow Jones finished up 0.19% at 33,301. S&P 500 was up 0.21, closing at 4183. NASDAQ was flat, down 0.01, closed at 12,488. Small caps were down 1/3%. The VIX did pull back 5.73% today. It's at 3160. And let me bring up my chart here, and we can look at today's market, so you can see this is the Dow Jones. Opened up real nice. Let's see, it was up about 300 points. Came back within the first hour or two, went into the red, went back up. Let's see, what was its highest today? It was up about 400 points at its peak. And then, after about 2:30 Eastern time, it just really slid back down and remove my line here. And let's see, it dropped about 345 points from near the highs at, like I said, in the 2 o'clock hour Eastern time. So, these things do happen, but like I said, I think the markets have run out of a lot of steam. Look at the NASDAQ. Again, it opened up pretty good. It was up about 1.6% and then wound up finishing flat for the day. So not the best day in the markets, unfortunately. So, all right. Well, let me get back to the other indexes. The exchanges in Japan. Canada, they finished up 0.26%. Brazil was up 1.03. Mexico was down 0.35. Heading over to the European markets in Western Europe, Germany was up 0.27, UK up 0.5%, France was up 0.5%, the Euro Stoxx was up 1/3, Netherlands up 0.11, Spain was up 0.5%, same with Italy, Switzerland up nearly 1%, Portugal up 0.5%, Belgium down 0.12. Moving over to Eastern Europe, Austria was up 1.2. Sweden up 1.5, Denmark up 0.92. The two Russian exchanges were up 4.56 and 4.92 respectively. And getting over into the Asian markets, Australia was down 0.78, New Zealand was down 0.78. Shanghai in China was up 2.49. The SESE component up 4.37. The China A50 up 2.05. The DJ Shanghai up 2.77. And the Hang Seng was flat at up 0.06. The Taiwan weighted was down 2.05. And the rest of these smaller ones were mostly down, except for a couple small ones here in Vietnam and Sri Lanka. So as I said, not the best day in the markets, but, hey, these things do happen. So totally not unexpected. So let me mute this for a second while I blow my nose. Allergies are just brutal right now. So, all right. Let's go ahead and read today's market recap. S&P 500 jumps as Microsoft leads rebound in tech. Written by our friend Yassine Ibrahim from Investing. The S&P 500 climbed Wednesday as technology rebounded from a rout a day earlier, supported by a rally in Microsoft following better than expected quarterly results. Alphabet and Microsoft kicked off the quarterly earnings for big tech, but it was the latter's quarterly results that helped steady sentiment on tech. Microsoft rose more than 6% after reporting fiscal third quarter results that beat on both the top and bottom lines, led by strong growth in its cloud business. Quote, the key metric that moves the stock, Azure cloud revenue, accelerated to 49% constant currency growth from 46%, the fastest pace since Q4 of 20 on double the revenue base, Oppenheimer said in a note. Alphabet, meanwhile, fell more than 3% after the tech giant reported first quarter earnings that missed on the bottom line, paced by weaker than expected growth in its YouTube business. Quote, YouTube's second miss in a row was the main controversy, RBC said in a note, as the streaming platform battles TikTok with YouTube Shorts. Meta Platforms, the parent of Facebook, continues to the flow of big tech earnings with its first quarter results after the close. Semiconductor stocks struggled to turn positive, weighed down by a slip in shares of Texas Instruments. The chip maker fell more than 2% as its better than expected quarterly results were offset by weaker guidance as COVID restrictions in China are expected to dent growth. Chip makers will remain on in the spotlight as Qualcomm rolls out its quarterly results after the market close. Beyond tech, Boeing fell more than 8% to keep gains in the broader market in check after reporting first quarter results that missed on both top and bottom lines. The aircraft maker also said it would halt production of its 777X plane, with deliveries not expected to begin until 2025. Visa, meanwhile, played a role in lifting the broader market after the payment processor reported better than expected quarterly results and said it expected further growth as spending on travel picks up pace. Energy racked up gains as oil prices pared losses despite the impact of the dollar strength and concerns about demand following a spike in COVID-19 cases in China. Oil prices were also helped by data showing U.S. crude weekly crude stockpiles rose last week. This doesn't make it. Let me read this to you. Oil prices were also helped by data showing the U.S. weekly crude stockpiles rose less than expected last week. I guess it rose less than expected. Again, I don't know. I think a computer writes these things. Valero, APA, and Devon Energy were among the top gainers in the energy sector. So kind of a mixed bag today. Looks like some tech were beat up pretty good. And others, did fairly, did the opposite and were doing pretty good. So, all right. Next article here: U.S. goods trade deficit hits record high. Q1 GDP growth estimates are being slashed. It's written by Lucia Mutakani. The U.S. trade deficit in goods widened to a record high in March, likely as businesses who are worried about shortages front-loaded imports after Russia's invasion of Ukraine, raising the risk that economic growth stalled in the first quarter. They like to throw that Russia-Ukraine thing in on every single little problem. I mean, next thing we know, you're going to blame, I don't know, shortage in TP on, Russia-Ukraine, when in reality, they have nothing to do with it. So, all right. The report from the Commerce Department on Wednesday also showed solid increases in retail and wholesale inventories that could offset some of the hit to gross domestic product from the sky-high trade gap. The data prompted economists to downgrade their already low GDP growth estimates for the first quarter to show the economy barely growing or even contracting. I've been saying this. The government is due to publish its snapshot of first quarter GDP on Thursday. Economists cautioned against reading too much into any number, as it would be a misleading picture of the economy. Quote, while first quarter GDP growth looks weak overall, domestic final sales performed fairly well during the quarter, said Daniel Silver, an economist at JP Morgan in New York. The goods trade deficit jumped 17.8% to an all-time high of $125.3 billion. The increase likely reflected both higher volumes and prices. Imports of goods accelerated 11.5% to $294.6 billion. They were boosted by a 15% surge in imports of industrial supplies, which include petroleum products. Imports of consumer goods vaulted 13.6%, while those of motor vehicles increased 12%. There were also solid gains in imports of food and capital goods. Quote, front loading of imports related to Russia-Ukraine war likely drove much of the import spike as firms boosted inventories of commodities and finished goods in anticipation of potential shortages, Goldman Sachs said in a note. The United States and its allies have imposed a range of sanctions against Russia for invading Ukraine. Both Russia and Ukraine are major exporters of commodities, including wheat and sunflower oil. Exports of goods increased 7.2% to 169.3 billion. They were led by a 12.3% rise in exports of industrial supplies. Motor vehicle exports advanced 8.4%. There were also increases in exports of food, capital, and consumer goods. Trade has subtracted from GDP growth for 6 straight quarters, the longest such stretch since the beginning of 2016. With the goods trade data in hand, Goldman Sachs lowered its first quarter GDP estimate to a 1.3 rate from a 1.5 pace. JP Morgan slashed its forecast to a 0.7% pace from a 1.1 rate. The IHS market believes the economy actually contracted at a 0.6 rate, a downgrade of 0.7 percentage points. So, like I said, I've been saying for a while that we're going to start seeing some contraction in the economy. A lot of it has to do with the stimulus has run out that was poured into the economy over 2 years ago, and when that money runs out and the music stops, you got to find a chair really, really fast. So, again, not surprising that is the case. All right, next article has to do with oil. Oil prices dip as dollar soars. U.S. crude stocks edge higher. Written by David Gaffin from Reuters. Oil prices dipped on Wednesday as a soaring U.S. dollar made barrels more expensive and coronavirus outbreaks in China clouded the economic outlook in the world's biggest importer of crude oil. Supplies remain tight in the world's largest oil producer, the United States, as government data showed. Crude stockpiles rose modestly last week as fuel inventories declined. Brent crude futures fell by $1.08 or 1% to 103.91 a barrel as of 12:40 p.m. Eastern. U.S. West Texas Intermediate crude futures dropped $1.19 a barrel to $100.51. The dollar rose to its highest in 5 years, making oil purchases more expensive for holders of other currencies. Quote, This is a risk-off environment with stronger U.S. dollar and mobility restrictions in the second largest oil consumer, China, said UBS commodity analyst Giovanni Stavuno. The U.S. Energy Information Agency said crude stocks rose by just 692,000 barrels last week, short of expectations, while distillate inventories, which include diesel and jet fuel, fell to their lowest since May of 2008. Probably why diesel for my truck is so damn expensive right now. Energy markets worldwide are dealing with massive disruptions to supply following Russia's invasion of Ukraine and subsequent sanctions slapped on Moscow by the United States and its allies. UK major Shell said it would no longer accept refined oil blended with Russian products, according to trading documents, while ExxonMobil said it had declared major force majeure on its Sakhalin-1 operations in the far east part of Russia. This week, Moscow escalated its use of energy as a cudgel against countries opposed to the invasion. Russian energy giant Gazprom said on Wednesday it halted gas supplies to Bulgaria and Poland. European Commission Chief Ursula von der Leyen said Russia was using fossil fuels to blackmail the EU, but added the era of Russian fossil fuels in Europe was coming to an end. I doubt that. Germany, which has relied heavily on Russian energy, faces a hit to economic growth as it pushes ahead with attempts to become independent of Russian gas and oil imports. Germany's economy minister said plans to take control of the PCK Schwedt refinery, majority owned by Rosneft, and the last big buyer of Russian crude in Germany, were progressing. China's central bank said it would step up monetary policy support as Beijing races to stamp out a nascent COVID-19 outbreak in the capital and avert the same type of debilitating citywide lockdown Shanghai has been under for a month. So, from what I understand, and just from what I've been reading, is that Russia's still selling oil. Yes, they're selling it at a discount to India and other countries, but the, I guess, U.S. allies, as they like to call it, they're cutting their nose off to spite their face. Again, this is a boundary dispute with Russia and Ukraine. And, Russia's pretty pissed off just of all the coziness that Ukraine has had with the NATO countries over the last couple decades. You know what? I don't blame them at this point. So, if Russia wants to go and crack some skulls, I don't care. It's not my problem. And, what I do find humorous is all the people here in America who are losing their minds. Oh my God, Putin's the worst person in the world. Well, I didn't hear any of you bastards complaining about our own government invading Iraq, Afghanistan, Somalia, or dropping bombs on Somalia, Syria. I mean, the list goes on. I mean, my entire life, our government has done awful things. And you don't just completely, monkey see, monkey do. You cover your eyes, cover your ears, and you don't say anything. So, you're a bunch of damn hypocrites out there. And, I find it very irritating. Anyways, all right. Got another article here, has to do with home prices. Comes from Fortune magazine. The odds of a home price decline hitting your local housing market as told by One Interactive Chart. Who wrote this? Lance Lambert. Fed Chair Jerome Powell has made it clear the central bank is done sitting on the sidelines as inflation chips away at the value of the dollar. The plan? Put upward pressure on interest rates until price growth relents. Historically speaking, the inflation fighting playbook is particularly hard felt in the housing market, where spiking mortgage rates can quickly price out home buyers. That's already starting to happen. On Thursday, the average 30-year fixed mortgage rate hit 5.11%, up from 3.11% in December. A borrower who took out a $500,000 mortgage at 3.11 rate would owe $21.38 per month. At 5.11% rate, that monthly payment on a 30-year mortgage spikes to $27.18. So about an extra $600 for that 2% increase. While the swift movement up in mortgage rates is undoubtedly putting downward pressure on the housing market, it doesn't mean home prices are about to crash. In fact, every major real estate firm with a publicly released forecast model, including Fannie Mae and Zillow, still predicts home prices will climb further this year. That said, industry insiders tell Fortune there's increasingly a chance that the economic shock, caused by soaring mortgage rates could see home values fall in some overpriced housing markets. To better understand which regional housing markets might see a price decline, Fortune reached out to CoreLogic. The California-based real estate research company provided us with its assessment of close to 400 metropolitan statistical areas. CoreLogic, which ranks number 952 on the Fortune 100, puts housing markets into 5 categories based on the likelihood that home prices in that particular market are to fall over the coming 12 months. Here are those groupings. Everything from elevated, with a 40% chance, down to very low, which is a 0 to 10% chance. So you can see across these metro areas, like here's the Denver area, it's home prices dropping over the coming years, still very low. And go over to an area like here, Salem, Oregon, it's elevated. A couple of other reds here, you see the Hartford, Middletown area of Connecticut. And where's this? The urban area of Honolulu. Right. Among the 392 regional housing markets that CoreLogic measures, it puts 86% into the very low or low likelihood of a price decline. It put 10% of markets into the medium grouping and 1% into the high grouping. Meanwhile, CoreLogic places only 2% of markets in the elevated group. The markets in the elevated group grouping, the highest odds of a price correction include Hartford, Kalamazoo, Lewiston, Maine, Mount Vernon, Washington, Muskegon, Michigan, Olympia, Washington, Salem, Oregon, and Honolulu. Even in the face of soaring mortgage rates, CoreLogic still thinks the chances of a price decline in 2022 are very low. Why? The real estate research firm points to the mismatch between inventory and strong buyer demand. That's also reflected in its national forecast. Over the coming 12 months, CoreLogic predicts U.S. home prices are poised to rise 5%. That mark a deceleration from the 19.8% jump posted over the past 12 months, but it's hardly the relief priced out buyers are seeking. However, that doesn't mean CoreLogic's views on the housing market boom as healthy. CoreLogic also calculated whether local income levels could support local home prices. The finding, CoreLogic says 65% of U.S. regional housing markets are overvalued. That includes every major market in the United States, like Arizona, Florida, and Texas. Just 9% of regional housing markets are what CoreLogic deems undervalued. 26% get its normal label. So you can see here, here's the Houston area, it's overvalued. The Denver, Colorado Springs corridor here in Colorado. And I think this has more to do with the, overvalued, undervalued based upon the incomes in those areas. Not long after the strict COVID-19 lockdowns led up in 2020, the housing market began to boom. Economists at the time weren't worried. In their eyes, the demographic wave of first-time millennial homebuyers, the influx of work-from-home buyers, and low mortgage rates all supported the price boom. In recent months, however, their tune has shifted. Just last month, researchers at the Federal Reserve Bank of Dallas published a paper warning that a housing bubble could be brewing. Meanwhile, last week, housing economist George Ratui proclaimed that, quote, "We're not in a housing bubble just yet, but we're skating close to one if prices continue to rise at the current pace," end quote. Increasingly, industry insiders are rooting for spiking mortgage rates to rein in the unsustainable levels of home price growth. That includes Logan, this name, Matashimi, lead analyst at HousingWire. He'd like to see soaring mortgage rates cause some homebuyers to pause their search. If that happens, inventory could finally get the breathing room it needs to rise again. Quote, "It's too many people chasing too few homes. We desperately need a breather," he says. I'm not going to try to say that name. So, like I said, once the interest rates go up, you are going to see a cooling. Well, I would imagine you'll see a cooling in the home buying process, simply because most people just don't buy houses with cash these days. And with that said, we're some areas that people are moving out of, you might see prices really start to slide, especially some of the bluer cities. States that are predominantly more conservative or libertarian in their views, I would imagine you'll probably stay fairly flat, if not still have a little bit of upside to them. So, all right, last article has to do with retirement savings. We need a new savings option to ward off retirement funding crisis. This is written by Robert Merton. All right. The financial independence and security of families lie at the heart of functioning democracy. I hate that word. Democracy is trash. It's mob rule. We live in a republic. The U.S. three-legged retirement system, Social Security, employer-provided pensions, and private savings and investments is in the grip of a serious funding challenge. Some would say a crisis. The reality is that a dignified middle-class lifestyle continued into the retirement years is no longer secure. To curb the fastest inflation in 4 decades, the Federal Reserve raised interest rates by 1/4 percentage point and signaled 6 more increases this year. But this move only adds to the uncertainty faced by retirees, which stems from a broad misconception that there is no good way to inflation-proof your investment. There are, in fact, numerous strategies for individual investors and countries to consider, including TIPS, Treasury Inflation Protected Securities, ICE savings bonds, and inflation swaps. One such pension-like bond innovation, which I helped to create, is known as SELFIes, Standard of Living Indexed Forward-Starting Income-Only Securities. Boy, that's a mouthful. These could be an excellent currency for retirement and particularly relevant for inflation challenges at hand. Central to the financial security of society is retirement that maintains a comfortable standard of living, which is measured by the amount of sustainable lifetime income received and not by the size of the accumulated pot. Since significant numbers of middle-class workers are now living longer and confronting rising inflation, many face future retirement without the reassurance of an adequate pension. As we entered the 21st century, employers discovered that the cost and risk of funding their pension benefits were much greater than anticipated. Private sector employers largely abandoned the once prominent defined benefit pensions of the past, replacing them with defined contribution plans with smaller contributions than in the past, and employees taking on benefit risk. So a defined benefit plan is just simply a pension. A defined contribution plan is a 401k, 403b, all that stuff. So if it says defined contribution, you're putting the money in it. If it's a defined benefit, your employer pays for it. Well, I guess in the end, you're paying for it too. So it comes out of your compensation package. As a largely unfunded pay-as-you-go system, U.S. Social Security is facing numerous solvency and structural issues, raising concerns about funding for future benefits. Moreover, it was never designed to be the full answer for retirement funding. DC plans have been the workhorse of accumulation for the past 2 decades and now represent 59% of the 38 trillion in total U.S. retirement assets, which includes the Social Security Trust Fund. This percentage will continue to grow, raising the prospect that employees will not save enough for retirement. Of the 58% of U.S. workers with access to employer-based DC retirement plans, fewer than half participate. At the same time, only 10% of workers contribute to private savings plans. Changes in employment patterns, such as the development of the gig economy, in which staff have no pension benefits, threaten to leave segments of the workforce with little security in retirement. Around the world, individuals will increasingly be asked to take responsibility for their own retirement planning, including making decisions that few are equipped for. On such issues as compound interest and considering the impact of inflation, they are being burdened with 3 complex, interconnected decisions: how much to save, how to invest, with many additional decisions, and how to accumulate one's portfolio at retirement. There must be a better way. Selfies are a government bond with a payout designed to match the pattern from a pension, with level payouts starting at a specified date, typically the retirement date, for a fixed period and index per capita consumption. This single liquid, low-cost, low-risk instrument is easy to understand for even the least financially confident individual, because they embed accumulation, decumulation, and compounding with standard of living and inflation adjustments. Insurance companies and pension funds can use these bonds to hedge their annuity and pension liabilities. Their tax treatment is the same for other government bonds. They are also good for governments as they lower the risk of individual retiring poor and improve balance sheet management. They can be used by those without access to a pension system. More such innovative instruments from academics, politicians, and others are needed if we are to ensure more people can retire with resources that can withstand inflation and provide the security they need. Why academics and politicians? Those are the people who've created all these problems. I wouldn't trust any of those 2 groups of idiots with, watching my dog. I mean, people who work in government and the academy are some of the most unimpressive human beings I've ever met in my life. I mean, to either read a paper or listen to them talk is the biggest bunch of word salad I've ever digested. A perfect example. I was listening to the Project Veritas call, all hands call that they put out from Twitter from I think it was on Monday, and the amount of words said to actual content is very dramatic. I mean, these woke idiots love to use tons of words, but don't actually say anything. And it's just funny to listen to these people, spout word salad and actually say nothing at all. So, anyways. All right. Well, that's everything I had for today. So I hope everyone has a wonderful evening. And I'll be back tomorrow with Thursday's Liberty Call. If anyone needs something from me, please head over to dsafinancialgroup.com and you can send me a note, drop me a phone call, schedule a meeting. Maybe you need to get your retirement plans in order. Now's certainly the time to do it. We've talked about a number of articles that things aren't certainly getting any better anytime soon. So now would probably be the best time to get your crap together. So, all right. Well, hope everyone has a great night. I'll be back tomorrow and y'all have a great evening.